Again, three main changes I can talk about is, first is of course digital disruption. So we do expect some so-called disruption to our business. In particular, could be our margin and the fee. But we are not worried to the extent that you would think that it would significantly eat away the market share of the traditional banks. But it does have implication on the income stream. Okay. As far as the other digital disruption is concerned from big tech and the fintech, we do see major disruption coming in from the payment space. And that have implication on our traditional banking model. And we have to respond to be a lot more efficient in the way we do our traditional business in order to survive and generate the kind of return that is adequate to compensate for the risk being taken by our shareholders. To do that, we really have to continue to emphasize on our ability to underwrite credit well and to conduct ourselves well to earn the trust of our customer base. And that is the only way for us to be remain to be a trusted custodian of public funds, okay, compared to new digital players, which we think they will not be able to scale to the level that is systemically important without being regulated. Yeah. So the best way for us to respond is to continue to emphasize on our ability to retain the trust of our customer base. The second major challenge or digital, the risk landscape that is changing is the climate change. And that is actually a very significant so-called challenge for risk management professional, because we would have to acquire new skill set to manage or to estimate what is the implication on our loan portfolio. That is something that is actually expected under the TCFD disclosure requirement. So the challenge is actually try to how to quantify a scenario whereby there is a climate change of 2% increase in the climate. What is the implication on our loan portfolio? And that is a major challenge, how to estimate, especially if the majority of our loan portfolio are SME customers and the information available is quite limited. So we are thinking of very much on how to acquire that kind of skill set by collaborating maybe with university. At the same time, try to build in-house expertise to collaborate with them in order to have evidence-based scientific approach to estimate what is the implication on our loan portfolio. On the other hand, there is also a lot of opportunities for a bank like us to actually develop new product for green financing. And that also we need to develop a new skill set, a new way of looking at credit, because this is a whole new industry being opening up for us to actually encourage borrower to go green by providing green financing. Okay. The challenge for Singapore, and we being one of the key banks in this region, is the fact that as a developed country in a growing region that is actually developing at different pace, we have no choice but to take the lead. But recognizing that it is not a solution by enforcing the best global standard on everyone, because the pace of development, the stage of development for all these countries around the region are very different. And therefore, we have adopted a more pragmatic approach to play a constructive role to actually promote changes over a period of time. Okay, what we expect our existing borrower to do, of course, is to meet the minimum requirement of their respective legal regime that is in place. But we would constructively engage them to continue to improve based on a global standard over a period of time. Yeah. So playing that role, we will think that it is a lot more constructive without disrupting the economy. Third major change in the risk landscape that we see, that I see in particular, is about FRS 9 and the expected credit down cycle coming up, because we are in the 12 years of expansion since the Lehman crisis. The things have changed since then is accounting standard on how you calibrate and account for credit losses. Now, the FRS 9 challenge to me is the fact that it is very pro-cyclical, in the sense that when you are facing a down cycle, the onus is on the bank to move many of the credit that is not impaired yet, but they are subject to significant credit deterioration, okay, into the category 2 and subject to from 1 year expected loss provision into a lifetime expected loss provision. My fear is that that change during a credit down cycle could be massive. And that is the worst of time to try to put in significant provision when the public confidence are fragile. So it is something that we as risk management professionals have to be very careful about how to deal with that. So we are hopeful that the regulators around the world take that into consideration, because the pro-cyclical effect of that provision can trigger unintended consequences on financial stability.